If you are purchasing, buying into, or selling your practice, normally the contract price will be allocated across different assets. Some of these assets will be capital, and some will be revenue in nature. It is important to make a distinction between capital and revenue because they have different tax treatment. From the buyer's perspective, payments made on revenue account are tax deductible, whereas capital payments are not. From the vendor's perspective, capital payments may be eligible for capital gains concessions. In some cases, the gain can be completely disregarded. If the payment is made on revenue account, it will be a part of ordinary income and will not be eligible for concessions. Apart from physical assets, the purchase price may also include some intangible elements, such as goodwill, earn-out rights, restraints of trade, and other rights and obligations arising from the contract. With intangible elements, it is not always easy to say if the payment has capital or revenue character. The difficulty was perfectly demonstrated in Healius' case. In this case, Healius, which was formerly known as primary healthcare, made a number of lump sum payments to medical practitioners in exchange for their commitments to conduct their medical practices from one of the centers owned by Healius. The period of contract was normally 5 years. At some point of time, Healius received a tax advice that these payments could be deductible, so they lodged an objection to amend their tax returns for a number of years. The ATO disagreed and the matter ended up in court. At first instance, the federal court found that these payments were not capital, that the practitioners did not transfer their goodwill to medical centers and they did not form part of the business structure of these medical centers because they were still practicing independently. The payment was simply to secure a revenue stream for Healius for a number of years. So consequently, the payments were deductible. That decision was overturned on appeal to the full federal court in October 2020. The full federal court found that the payments were in fact for acquisition of capital asset. The practitioners, when they signed the agreement, they became part of the business structure of Healius, because without securing the commitments of the practitioners, Healius would not be able to open new medical centers. It is understood that Healius intends to apply for special leave to appeal this decision in High Court. So watch this space. One point I should make is, if the payment is treated as capital for one party, it does not necessarily mean it should be capital for the other party. There is no requirement of symmetry in tax treatment. So if you receive the lump sum under a similar arrangement, it doesn't mean you have to go and amend your tax return to include it as a capital gain. The Commissioner is of the view that these payments should be treated as ordinary income. Of course, the circumstances in each case are different, so it is important to seek professional advice. If you need help, give us a call on 1300 077 555.